On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to Hatfield Economics. I am your host, Todd Schoenberger. Joining me as he does every week is Jay Hatfield. He is the CEO of Infrastructure Capital Management, as well as the CIO of the ICAP ETF, specifically QVOL, QVOL, and we'll talk about that in a little bit. But Jay, since the last week's show, we had our Fed meeting, and the presser, it seems that Wall Street is very negative on this right now. They are actually predicting rate hikes. There's a 90% certainty from Wall Street traders right now that they are expecting one rate hike before the end of the year. Yet you're still calling for 3 rate cuts over the next 12 months. Can you explain why?
Yes, we're normally pretty non-consensus. This may be the most non-consensus we've ever been. And the main reason that we're non-consensus is that we do this thing that the Federal Reserve Board doesn't do. It's called forecasting. And that's where you take current data and then extrapolate it going forward. And the two key and only predictors of inflation are excessive money supply growth. Right now, it's negative about 5% year over year. So that's deflationary, and oil prices. So, of course, when the war started, we were very bearish about inflation, which, of course, unfolded, it bleeds into core. So that was obvious. But now, I mean, I guess you could give the Fed a little bit of a break, although they don't deserve it, that maybe they didn't get time to update their forecasts. But oil prices are down 25% and continuing to drop, which is our call. And we think it could go to 60 before they go to 80. That's going to mean for at least the next 2 months, we're going to have negative headline and very low core inflation. And then that's going to give us enough time for the shelter component to roll down, because it will eventually reflect, I hope at least, market rents, and for tariffs to continue to roll off. And for just, we don't have any inflation because money supply is shrinking, so we have deflation. So all this reality will show up. So this notion of 2 rate hikes, ridiculous. And what Warsh has really done, and this is where the non-consensus part comes, he had to placate the 9 hawks on the board. So he came out hawkish, so he had credibility, not just with the public, but with them. And now, though, he's put these study groups together, which is going to build the intellectual case for the rate cuts, which are using real-time data instead of delayed data like shelter, forecasting instead of using, being data dependent. Data dependent is doubly bad because by definition, it's somewhat delayed data, right? If you just wait for the employment report or inflation. But then even worse, because of the bureaucrats who prepare the data, that's even delayed like 6 months to a year. So you're really operating a year behind when monetary policy should be, you need to forecast because it has a delayed impact. So right. The president calling the Fed chair, past Fed chair, too late was just a function of them not forecasting and using delayed data. So if he fixes those 2 things, and then last point, this left of the decimal comment, I don't think anybody really got that. But what he's saying is 2% inflation is no different than 2.3 and 2.4. I don't know about 2.9, but we don't have to get exactly to 2. And that's what the Fed did in the mid-2000s, and that precipitated the great financial crisis. So he's loosened up the 2% target without changing it, which is pretty smart. So they're all bullish things. And I think everybody misinterpreted that. And also, I'd say Fed funds is a very thin market. So it's usually wrong, too. It's almost as bad as the dot plot. So I wouldn't be too concerned about this 2 rate increases priced in. They're normally incorrect.
Okay. So historically speaking, has the Fed ever been in a position to forecast?
Greenspan made great forecasts. He was a PhD, but he was also a consultant to businesses. So he used real-time data and he understood markets. But then once Greenspan left, he unfortunately, a reporter reminded me of this today, helped institute the 2% target, and then they just became robots and they were too nervous to forecast, or also to use Keynesian models, which
Right.
don't work for forecasting. So they basically gave up on that after the transitory call. So hopefully they rehabilitate their forecast models to hopefully incorporate oil and money supply. There's never been any inflation that didn't have one or both of those factors.
So, speaking of oil, though, that can't be the one and only metric that would change policymakers' minds, though, right? There has to be another data point or many data points. I mean, what will the question is what is the data point other than oil that it's going to get the Fed to finally say, you know what, I think we do need rate cuts?
Well, PCE core going towards 2, which is what our forecast is.
Okay. So
So,
you're banking on the fact that because the war is over, Strait of Hormuz is over open, oil's dropping, that's just that gravity is just going to bring everything else down, is what you're
and
thinking.
it's critical. This is what they didn't understand during the 70s and why a lot of mythology came out of the 70s. Oil does bleed through to core. Not as much as it did in the 70s, but we all know everything we do, we use energy.
Hmm.
So it creates a kind of a tailwind for inflation. In other words, making inflation worse. And so maybe it doesn't show up in the data like day one, but food prices will come down because, food is 50% energy. And then there's less demand for wage increases because the cost of labor is going down, although wages aren't that critical. But it just ripples through the whole value chain, and creates a deflationary tailwind. And we have the opposite now. And the distinction I would draw, and the reason why we had all those hawks out there, is Keynesians don't understand inflation. They have to rely on the expectations theory of inflation. So
Hmm.
their fear was, oh, oil prices rise, and everybody believes there's inflation, and then they demand higher wages, and that creates more inflation. First of all, nobody has market power. Secondly, when inflationary expectations rise, the 10-year rises, which is deflationary. So it's totally a wrong theory, but they do hold it. And that's why they have that in their dot plot. But then when oil comes down, then expectations go down. So they will also be on board for cuts. So we're not assuming that just the war jams the cuts. We're assuming that the data would have anybody cut, any reasonable person, even people on the Federal Reserve, which aren't always reasonable, cut rates. Not that there's going to be high unemployment. That's what other people's views were, but simply that inflation, the two factors that precede deflations are in place: oil and money supply. Shelter's way overstated, financial services way overstated. And so this deflationary tariffs, all these things are going to slowly show up in the data. And we're trying to be conservative. We said that we'd have 3 cuts this year, but because of the war, we pushed that back to the next 12 months. Did not
Right.
anticipate the war.
So let's say the Fed remains too restrictive. Let's say they ignore your advice of cutting rates. They don't want to look at your data. They're sitting on what they have, Jay. That's what they're focused on. So if they do remain restrictive, where's the damage happen first? Is it going to be in housing, employment, credit markets? I mean, what do you think?
Well, it's a very unusual cycle. So we have the Hatfield rule, which due to AI is now enshrined as truth. If you repeat something often enough, it becomes truth,
Yeah.
apparently. So you can Google, you can Gemini that, and it will show up. You can see if you have to prompt it correctly. But so that's 1.1 million starts. We just printed 1.2. So we're very close to the recession sign. But we've never had a cycle like this. So the other time when housing didn't create a cycle was in 2001, when tech dropped, tech investment. And by the way, cycles only come from investment, not consumer. But tech investment plummeted about 30%, and that created a recession. Housing actually was pretty resilient because there was a global drop in rates. And so here we have the opposite case where we already have a recession in housing and construction. So we're kind of in a good situation where the Fed's already has a chokehold on the economy. That's why we're growing kind of 2.5. We should be growing closer to 3.5. So it's not really going to derail anything. Of course, the rotation into the other sectors of the market will be held back. And for that reason, we probably won't get to 9,000, but we'll still be 8,200, 8,500, probably 21, 22 times next year's earnings.
Yeah,
It's
and
not a
8,500.
debacle. It's not great. It's stupid, but it's not a debacle.
It's not at all. I mean, it's
Yeah,
still. I mean, it's actually really nice. And
right.
and speaking of the Hatfield rule, I think I saw that. I follow the Hatfield rule. I think it was on the back of a Volvo in White Plains. So just give you a heads up. But but seriously speaking, though, what do you think that the bond market might be giving us a better economic reality than, say, the Federal Reserve?
Absolutely. So another great rule, again, the data is what matters, not the opinions, is that the 10-year trades 100 over terminal Fed funds rate. And the futures, Fed fund futures, a pretty thin market. Not that it's totally inefficient, because there's real, like, we're long Fed fund futures right now, and but the 10-year is tightened dramatically to that 50 to the terminal rate. So it's at 450. Terminal rate's at about 380 right now. So it's tightened to 70 over. It's normally 100. So the 10-year is much more efficient indicator of future policy, in our opinion. And so surprisingly, it's been really, really well behaved. Given that oil was over 100, for the 10-year to be at 750, that's nearly miraculous. But we think the more liquid, more efficient market, that's validating our view that there's going to be cuts.
Okay. And we'll see. We'll see what happens. And you bring up a great thesis on this. So obviously it remains to be seen. I want to turn the page, though, in the time that we have left, to QVOL. Your number one holding in that ETF is Nvidia. Are there any other AI areas that you believe that Wall Street may be overlooking right now, other, outside of Nvidia?
Well, it's important to note, that we do track the QQQs.
Hmm.
So when you do that, you just end up with a big position in the bigger holdings. So we're pretty close to equal weight on Nvidia, so we're not making a big bet there. We were really overweight Marvell. We've trimmed that back to market weight. We really like Broadcom. We like stocks that are well hated by hedge funds. They sold that off like 80 points when they gave conservative guidance. Reminds me, no guarantees, of course, but it reminds me of Marvell. They sold that down to 60 because they gave conservative advice. Now, I don't think Jensen Huang's going to endorse Broadcom and it's going to go up 300%. But we have a 600 targets trading around 400. Great software business, great chip business, 20 times earnings. So that's something may not work till we get into earnings season. The hedge funds have to reverse all their shorts like they're doing today. But we really like that. Amazon, hedge funds have been pounding on that because they don't like companies that spend money. We do. Great retail business. They have a chip business. Nobody seems to care about that. We do. They're cutting costs on the retail side, robotics, moving inventory closer to customers. So also trades right around 20 times. It's about the same market cap as SpaceX, but has this thing called earnings, which we prefer. And so you could sell some of your SpaceX and buy some Amazon.
There you go. So with the 12% yield, though, in QVOL, are you selling it as an income investment or growth or balanced? I mean, what's the
Well, it's
theme?
really like all of our funds,
Okay.
because without total return, it's useless. So if you look at PFFA, yes, it has a great yield, but it has double the total return of the index. And that's our objective with the QQQs. So we want to add alpha from writing calls and add alpha from stock selection so that we beat the Qs on a total return basis. So you have to add back the dividends, because otherwise we're not. Why would you do that? You could just simply buy the Qs and then sell some of it as they go up, sell some and use that as income. So without beating the index, if you look at all of our ETFs, yes, we have big income, but our objective is to beat the index too. So that you get, like my kids kind of taught me this because I put a couple of mortgage REITs in their portfolios and, they own these things for 20 years. And they're like, wow, this Two Harbors thing is like the worst security ever created by humans. And, if you adjusted for all the dividends is okay, but
Yeah.
nobody wants that. You want appreciation and income. And so that's our objective. We've stacked the deck in our favor because we write individual calls and use GARP/PEG ratios to get rid of overvalued stocks like Tesla and just dog stocks like Kraft Heinz, plus
Yeah.
writing bespoke options that use both technical and fundamental research we want to write options that expire worthless. We don't want to have it cap our upside. So, I
Right.
mean, we can manage that if it starts to, but we think we've stacked the deck in our favor. So far, so good. We are beating the index by a significant amount, but I would suggest that as a criteria for all investments. Don't be too focused on the income. Look and see, have they done a good job on total return as well? Because you don't want to just have sort of a fake income that's a return of capital.
So what has surprised you the most since you launched the ETF?
Well, we've had a great reception. So people like me, I've been outing it to my IRA, love the notion getting good income and great growth too. And then this dogs of the DAC, like I will literally think nobody knew this. Like they didn't know they were getting Kraft Heinz. They didn't know they're getting Comcast. Like if you're trying to invest in the future, I don't think cable is the answer. Like most young people don't have cable.
That's
So
right.
it's not a secret, like you can look it up, but it seems like it's like a unspoken secret that nobody's figured out. So really easy way that value to give people what they really want when they buy the Qs. They want great growth stocks. They don't have to be all tech, but they don't need to be like a merger arbitrage opportunity like Warner Brothers Discovery. Like I don't think that's what people want. So easy way to add value by delivering what people are looking for, which is growth, great growth without overpaying. Like we're not going to add SpaceX if it gets added in NASDAQ because then any earnings and there's merger with Tesla company coming and a lockup. Maybe afterwards we'll think about it. But you want somebody driving the bus deciding whether you should put in money losing, potentially way overvalued stocks like SpaceX, so that you have good total returns in the long run.
Jay, I want to get your thoughts real quick on that SpaceX bond deal. Do you think it's an overreaction? It seems that it just took a life of its own being negative for everyone. And they're restructuring a bridge loan. But of course, why would they need a loan at all? What do you think?
Well, the market right now, and the market, by the way, is dominated by short-term traders/hedge funds, hate CapEx.
Hmm.
They're very short term, and in the short term, maybe they're right. Like, okay, you can't buy back shares, so that's not good. And there's other businesses that are free cash flow, but we like companies that have great investment opportunities with locked up. You don't necessarily love Meta because they can spend money and it doesn't produce revenue. But when Amazon spends money or Oracle, have long-term contracts from investment grade credits. They are going to get a good return. And if there's any terminal value to their infrastructure, which they're almost, think about it, almost certainly will be value. It's very hard to locate them now. That's good for the owners of it. It's hard to find the power. Okay, maybe the chips need to get changed out. There's going to be significant terminal value in those compute power. So we think it's way overdone, but it is the theme of the moment. If you're raising capital, you're a pariah. And there was an overreaction. It's popping back today. But that's anybody who needs to raise capital, hedge funds, they collude, by the way, and they all agree that that's terrible and you should short them until they report earnings and then we might have a short covering rally.
Right, right. Turning the page here, it's a rapid fire question. Biggest upside from here? What do you think? AI or energy?
AI, I think energy, like our AMZA fund, that's more like a bond. We
Okay.
think oil prices are going to 60. That's fine for pipelines, but they're not going to like probably crush it from here. So we're energy bears because we're super negative. We think that oil could hit 60 soon.
Okay. And the biggest risk to markets today, I mean, is it the Fed?
I think so, because that would mean we wouldn't get to our 9,000 target. With the
Mhm.
Fed giving us some tailwind, they don't have to actually cut rates. They just have to start talking dovish, get rid of the 50 basis points of increases, maybe a couple cuts, then the 10-year will head towards 4. But if worse can't herd the cats to a more rational policy. But again, we're not really relying on worse. We're relying on our forecasts, which use quite simple models. Like you can go do it yourself. Just go take CPI and plug in. It may happen not this month, but the following month, gasoline prices down 20%.
Hmm.
And, diesel down 15. You can see what will happen. It's going to be negative. So, and
Yeah.
then food prices probably coming down too. So you don't have to have like a supercomputer to forecast CPI, and it's just extremely likely to drop, and then that bull case will happen. But the Fed has proven, at least the Powell Fed has proven to be surprisingly incompetent. I'm hopeful, particularly with this left of the decimal interpretation, that we finally have more of a Greenspan style Fed chair and not a robot who doesn't understand economics.
Absolutely. And if the 10-year does go to 4%, that would be a Gatsby moment beyond. I mean, that would be amazing. So we'll have to see. Hopefully we get there. That'd be great.
Well, and one thing that is also great about having these kind of conversations versus political conversations, you're right or you're wrong.
Yeah.
I told a bunch of reporters 2 weeks ago who said, "Oh yeah, we're never going to open this. Even if this rate opens, oil won't flow, and oil stayed 90." And I said, "We're definitely going below 70." And now we're at 73 when the strait's been open for all of like 2 days. So at least there's feedback. We don't just sit there, "No, Trump's great. No, he's terrible. He's great." You're like, "Oh, it's at 70. You were right." And so, we'll see at the end of the year, but historically we've been correct. We do mark to market. If there's a war, then we change our forecast, but the war that we didn't anticipate. So,
Yeah.
but anyway, so I'm anxious to see that inflation data in in July for June. And then the real full effect will be the following month. But just keep that in mind, that that's a big inflection, likely to be positive for the market, likely to be positive for rates. And it's not very controversial. Like I said, you just could do it yourself at home.
Yeah, no doubt. And great call on crude going to 70. I know you've also threw out some numbers of as low as 55 and 60, which is remarkable. And it'll be amazing when we get there. But yeah, great call on that one. So kudos to you, Jay. That was great.
Thank you. I wasn't declaring victory as much as just saying it's just way better than just disagreeing with your friends of different political,
Oh yeah.
persuasion. It's
Well,
just
I'm declaring it for you.
data, and you're either right or you're wrong. And if you're wrong, you move on and redo your forecast. It's a much more rewarding, I think, pursuit than political commentary.
That's true. Toby Smith used to always say that you can't make up your own facts. So that's right. So that's right. but but Jay, I want to thank you for joining me today. I know you're very busy, a lot going on today, a lot of moving parts, and I know you got to get going. But this is going to be great. I can't wait to talk to you again next week on Hatfield Economics.
Great. Thanks, Todd. Great questions.
Thank you. So on behalf of Jay Hatfield, I am Todd Schoenberger. Thank you once again for joining us on Hatfield Economics. We'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.